Well, let's talk more about this week's market moves and what it means for the Fed moving forward. Let's bring in Tom Hainlin, U.S. Bank Wealth Management Senior Investment Strategist. Tom, thanks for being here. So we just outlined what we have seen this week. All of it has equaled a little bit of a dip on the weekly basis in the markets. But how do we come out of this week with any kind of a clear picture? What do we do from here?
Yeah, Josh, Julie, great to see you both this afternoon. Thanks for having us on. You know, the market looks like it's going to end the week where it started. It's pretty close. So an event-filled week, but the market really is kind of finishing off flat for the week. But I think the real key this week has been watching expectations recalibrate in terms of what are people expecting that the Fed may or may not do in 2024. We got through the fourth quarter of last year. You had expectations as high as 7 rate cuts priced into the bond market. Now that expectation is down to about 3.5. You squeezed out this sort of excess enthusiasm or optimism for the Fed and expectations for 2024. We think that's been leading to a lot of the volatility we've seen as we closed out 2023 and started 2024. We're now kind of almost back to where the market's caught up to the Fed, which sets up that key Fed meeting coming up here in March.
And as you look ahead to these Fed meetings, Tom, I mean, what is your call? When do you think they start cutting in by how much, and how much does that impact, Tom, where and how you want to put money to work?
Yeah, so at the December meeting, the Fed kind of moved the dots from 2 to 3, and the market tried to kind of run ahead of that quite a bit. We're most interested to see kind of what that dot plot looks like coming out of the March meeting as the Fed changed their expectations for what 2024 looks like now that the market's kind of caught back up with it. You noted the hot CPI print, the hot PPI print. You know, that's likely to keep the Fed kind of where they are, at least through the first 5 months of the year, perhaps 6 months of the year. So that kind of pushes us into a higher for longer rate environment in the first half. Then the question is how does the consumer respond to that, and how do smaller businesses respond to that, since they're more tied to shorter term interest rates and shorter term bonds for financing?
And also, I would ask how you respond to that as a strategist, right? How you respond to all of this. Are you changing your view as to where stocks are going to go, given some of this data that we've gotten recently, or do you hold fast to the strategy and stay the course?
Across different asset classes like stocks and bonds, for stock investors, we've been broadly allocated really across the market cap, large cap, mid cap, small cap. Obviously, the market is higher weighted toward those secular growth tech companies. That's where you've seen the strength of earnings and cash flows and visibility into those trends like AI and cybersecurity and cloud spend and that. So we've been cap weighted for investors, just recommending broad allocation. We do find areas of the bond market that are attractive. One of the things that's happened this week is you've had a backup in bond yields. That provides some more interesting and attractive compensation for folks, especially sitting in cash looking to get invested. So taking advantage of bond yields where they are and where they've kind of risen to this week, those are kind of some of the areas of the market that we find interesting.
And Tom, for the U.S. stock market, I'm just interested, as you look ahead to 2024, what are the big risks, Tom? The red flags you see, is it sentiment, valuation?
Yeah, in large cap tech space, valuations run ahead, but that's because you've had more confidence in where the earnings have come through. So, cloud AI, the tech spend by companies remains strong. So it's not surprising to see resilience there. We've been waiting to see this more durable broadening out in the market. And I think the first step in that was this recalibration of rate expectations. So they were more in line with where the Fed was. Now it's watching through this first quarter and first 2 quarters of the year again, just to see how would consumers respond to rates staying up here at a 5.5% clip. And again, just seeing how small companies respond to that as well. So that we see those as maybe the areas of the market that we're going to be on the lookout for, is if rates do stay up here for the first, call it 5-6 months, how do smaller companies and consumers respond?
And then sort of how are you going to change your strategy given what they say, right, when it comes to equity specifically?
We're looking for opportunities to get more interested in those other sectors, right? So the cyclical sectors like industrials and materials. Now that we're kind of in a place where the market and the Fed aren't so wide apart in expectations, if we get this sort of settling into the economy, if inflation continues its gradual path towards the Fed's target, if the Fed signals it's now prepared to start to cut interest rates and kind of come off a restrictive level. We think there's opportunity then to see the market broaden out, whether it's other sectors, whether it's interest rate sensitive sectors like real estate or utilities, or smaller companies. So those kind of the mileposts we're looking at to get more attractive in these kind of non-growth areas of the market.
And Tom, I'll get you here on this. As a strategist, Tom, I'm just curious how much your clients are asking you about the election, Tom, and what are you telling them? And as a strategist, does it matter to you, Tom, who's in the White House, Republican or Democrat?
Yeah, I appreciate the question, Josh. We actually have a paper on that we put out late last year. You can find it in a search or on our website. And we looked statistically back all the way to the post-war election period, so 1948 to date. And we find there's little statistical evidence of major market moves based on the election outcomes. Obviously, industries matter, and different places where perhaps executive order or who controls the Senate in terms of confirmations. But in general, it's the economy, it's growth and inflation that seems to have a much stronger correlation with market performance than expectations or actual election results.
All right, Tom, thank you so much for helping us kick off the program. Appreciate it.
Appreciate it, Josh. Thanks a lot, Julie.